Okay, so we looked at just buying and selling. Let's have a little look about different order types. Now, different order types can be used to open a trade at a certain price level, close a trade to take profits, or you can close a trade to limit your losses. Let's have a look at each. Okay, so a market order, sometimes shortened to MKT, is buying at any price available, and that may be how you would just buy. If you went in and thought, you know what, I think the DAX is going to go up, I'm going to buy here, you would get your ticket up, you put £10 a point or whatever your stake may be, and then you would buy it, and that would be a market order. A limit order is an order to execute your buy at a specific price or better. Often it's not going to be better, but it's going to be at that price. So there are two ways of using a limit order. The first way is to get you into the trade. In other words, I'm not in a trade at the moment. If the market comes down to a level where I'm interested in getting involved in it, then I'm going to put a limit order in and get me into the trade. The second way of using it is to take profits. So in this example here, we've got as a chart example, you've bought at this arrow point here. This is the euro dollar from a long time ago. And you've put a limit order in at this point here, and you've left it. The market, and over the next 30 minutes or so, has come up and it's gone through that. Your limit order to sell has been executed and your trade has been closed. You've banked the profit. Now, on the flip side of that, you can put what's called a stop loss order in, and that does exactly what it says. It stops your loss. So it's an order to close your position at a predetermined price point. So here, for example, you would, if you've bought here, you've got a stop loss here under this under this cluster of price, and we'll talk a little bit more about that later on. So basically, if the price then reverses and comes down, you don't have to be at the screen. As long as you've got your stop loss in, as the market comes down and hits that level, it's going to exit you out of the trade because you've got a stop loss at that price, at that position size, at your position size of your trade. So there's two ways, extra orders you can use cleverly to get in or out of trades. Another one may be, if let's say I wasn't in the trade here but I wanted to be down here, then perhaps I'd put my limit order here, and if the price then came down and tagged it, touched it, I would be in the trade, and then I can then use another limit higher to get me out of the trade for a profit, or I can use a stop loss order below to get me out, to limit my loss if the market hits that. And there are also what's called guaranteed stops. Now you have to pay a little bit of a premium for those. What that basically means is if you're holding a position overnight and the market gaps and moves dramatically, you're going to have guaranteed the level that you're going to come out at. But for more information on that, have a look at the brokers that I will recommend later. They'll give you a much better overview on how they work for each specific company, because each company executes them differently. But the main things are, the market order just gets you in or out right now, whatever price is available at the time. A limit order specifies the price you're willing to trade at. Of course, you may not get filled. That's the disadvantage of a limit. You may not get your trade, or you may not get your fill, but you're determined to have that price. So you give up time sensitivity on that. And then a stop obviously takes you out of the trade if the market should go against you. So another example here, let's say the spread on this market is 1 point. So the buy price is, actually these are the wrong way around. Let me amend these live for you guys. Okay, so another little quick example here. This market's got a 1 point spread. The buy price is 1.10256. The sell price is 10255. Spread is 1 point. Very acceptable spread, whichever market we're looking at here. And this is how you would take this trade. You could put a buy limit, which means you're buying the market if it comes down to this level. Let's say you wanted to buy limit at this 1.1, you thought it was a good price to buy. You put a sell limit here, which would be about 1.1065 in between these two. So that means that if you bought here, you would be exiting here, or if you hadn't bought here, let's say you still wanted to go short here looking for the price to go lower, and that would still work. And whichever way the market moves, you're in short here or you're in long here. Obviously if you're in long here, you want to put a stop in to limit your loss, so you're going to put a sell stop. Obviously it's the opposing of the position you've got. If you've got a buy bet on, you want to sell it to close it for the size you've got at the level you want. Similarly, if you've got short here, you put a buy stop in above, and that will get you out of your trade. It's important to understand these because this is how you limit your risk in trading. Making sure that you're not on the wrong end of a move. If you are on the wrong end of a move, that you're out and you don't have that unlimited loss. That if you hold the position for too long, that could occur. So a great risk management tool to understand how to utilize stops and limits.